If someone told you that the retirement account you spent decades carefully building could create a tax problem, you might assume they had the math wrong. The account is large. The contributions were consistent. Retirement looks secure. But the concern financial planners often raise isn't about the balance. It's about the structure and whether the rest of your retirement picture was designed to work alongside it. Consider a hypothetical couple. We'll call them David and Ellen. Everything in this example is for illustration only. It is not financial advice. David and Ellen are both 65, recently retired, and spent 30 years contributing to traditional 401k plans. Their combined balance is approximately $1.2 million. They have Social Security benefits scheduled to begin, no mortgage, and relatively predictable spending. By most conventional measures, they saved well and built toward retirement the right way. Here's the first concept worth understanding clearly. Their 401k money is not tax-free money, it is tax-deferred money. Every dollar David and Ellen contributed went in before income taxes were collected. That was a genuine benefit. It reduced their taxable income while they were working and allowed the investment to grow without an annual tax drag. Those are real advantages, but deferred does not mean forgiven. When they withdraw from those accounts, every dollar is treated as ordinary income and taxed at their rate at that time. The government has been a silent partner in that account since the first contribution. The question isn't whether taxes are owed. The question is when and at what rate. In the early years of retirement, David and Ellen's taxable income may be manageable. Perhaps they're drawing modestly from savings, haven't started Social Security yet, and are keeping withdrawals low. But that window doesn't stay open indefinitely. Once both spouses begin collecting Social Security, and once they're taking withdrawals large enough to support their lifestyle, those income streams start to stack. Social Security is not automatically tax-free in retirement. Under current law, depending on your combined income, which is calculated as half of your Social Security benefit plus all other income, including tax-exempt interest, up to 85% of your Social Security benefit can become subject to ordinary income tax. Not the entire amount, but a substantial portion. And as total income rises, effective tax rates often follow. Then comes a point when something is added to the pile by law. Federal rules require that holders of traditional retirement accounts, 401ks, traditional IRAs, and most similar plans, begin taking a minimum withdrawal each year once they reach a specified age. Under current rules, that starting age is 73. Required minimum distributions are not optional. They are calculated based on the account balance and IRS life expectancy tables and are adjusted each year. For a balance like David and Ellen's, a required distribution could amount to tens of thousands of dollars each year when the obligation begins. That income is added to everything else they're already receiving, and whether they need the money or not, it becomes part of their taxable income for that year. The income that accumulates in retirement doesn't only affect a tax return, it can also affect Medicare costs. Most Medicare enrollees pay the same standard monthly Part B premium, but for those whose income exceeds certain thresholds, there are income-related monthly adjustment amounts, often called IRMAA, that add to the cost of both Part B and Part D coverage. For higher income beneficiaries, these surcharges can run into several $1,000s per year. What makes this easy to miss is the timing. Medicare looks at income from prior years when determining whether surcharges apply. A large distribution today or a substantial Roth conversion can affect what you pay for Medicare coverage in a future year, sometimes in ways that aren't anticipated when the decision is made. There is one more dimension that is often overlooked, and it tends to matter most at a difficult time. When one spouse passes away, the surviving partner generally loses the ability to file taxes jointly. In the years that follow, they file as a single taxpayer. The shift has real consequences. The standard deduction is lower. The tax brackets are narrower. The income thresholds for Medicare income adjustments are lower for single filers. And all of this occurs while total income may have declined only modestly, because the surviving spouse still holds the same retirement account and still faces required distributions. The result is often a higher effective tax rate at a point in life when there's less flexibility to respond. At this point, many people wonder whether Roth conversion is the answer. If the problem is that traditional account withdrawals are taxable, converting to an account where withdrawals are not seems straightforward. Roth accounts offer two relevant advantages. Future qualified withdrawals are generally tax-free, and Roth IRAs are not subject to required minimum distributions during the account owner's lifetime, which means the money can remain invested without being forced out on a schedule. But conversion is not automatically the right choice, and it is not free. The amount converted is included in your taxable income in the year of conversion. Convert too much in a single year, and you may push yourself into a higher bracket temporarily, or into Medicare surcharge territory you were hoping to avoid. Whether conversion makes sense depends on your current bracket, your projected future income, your time horizon, and a careful comparison of what you pay now versus what you might pay later. The broader framework behind all of this is sometimes called tax diversification. It doesn't mean dividing savings equally across every account type. It means having enough flexibility in where income can be drawn from that you can make deliberate choices based on your situation. A retiree whose savings are entirely in pre-tax accounts has limited room to maneuver. Every dollar of income comes from that account and is taxed as ordinary income. A retiree with savings spread across pre-tax, Roth, and taxable accounts can make more intentional decisions, drawing from a Roth account in a year when other income is already high, or taking a larger traditional distribution in a year when income happens to be low. The goal is not certainty, it is optionality. David and Ellen's situation is not unusual. A $1.2 million traditional account represents decades of disciplined saving and real tax advantages along the way. But the tax picture in retirement is layered in ways that aren't always visible from the outside. Account type, filing status, Social Security, Medicare, and required distributions interacting in ways that rarely announce themselves ahead of time. Understanding these interactions doesn't guarantee a better outcome. What it creates is more options. And in retirement, the difference between having options and not having them is often a matter of whether you thought about it before the decisions were already made. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Individual situations vary. A qualified professional can help you evaluate how these concepts apply to you specifically.